chimera.
And well, let's unpack this right out of the gate, because honestly, it feels like we are living in a split-screen reality right now.
Yeah, a massive disconnect.
Right. So on one side of the screen, you have the Nasdaq sailing to a fresh record high of 26,247.08.
Huge numbers.
But then on the other side of the screen, the Strait of Hormuz is essentially an active war zone. And, the Fed is practically shouting from the rooftops that inflation is stubbornly stuck. So how do those two realities exist in the same market?
It's wild, and it's exactly what we're going to figure out today on this deep dive. Because if you just look at the headline numbers, Wall Street's reaction to Friday's labor data looks like pure optimism.
Yeah, totally.
But beneath the surface, there's a very intense geopolitical tug-of-war actively moving global oil prices. Plus, a massive shift in corporate architecture that's driving the mega-cap tech rally.
Which is why our mission today is to help you understand the baseline narrative Wall Street is operating against. I mean, you don't have to agree with the market's optimism, but you absolutely have to understand the logic behind it to navigate it.
Exactly. You have to know the baseline.
Right. And real quick, before we dive into the first session, just a reminder for everyone listening that this deep dive is strictly for market context and discussion. It is not personal investment advice or an investment recommendation.
Absolutely. Context is everything here.
All right, let's get into it. Session 1. What set the stage before the U.S. session?
Right. So to really grasp why the market behaved the way it did on Friday, we actually have to rewind the clock a bit. We need to look at the massive wall of worry investors were facing on Thursday evening.
Because the geopolitical overhang was severe.
It really was. On Thursday afternoon, May 7th, the U.S. and Iran engaged in direct military clashes.
And this wasn't just a minor skirmish, right? This was Operation Epic Fury.
Yes, exactly. U.S. forces actively struck Iranian military sites. And the stated goal was to protect American destroyers that were navigating through the region.
Okay.
But Iran responded by firing missiles. And, critically for the global economy, they initiated strict blockade rules for the Strait of Hormuz.
Which is a massive deal.
Yeah, they started requiring commercial vessels to formally apply for safe passage.
Which immediately creates a choke point for a huge percentage of the world's daily oil supply. And, the market reaction to that Thursday backdrop was exactly the kind of panic you'd expect.
Oh, for sure. Brent crude oil spiked instantly.
Yeah, and that immediately poured gasoline on global inflation fears, literally and figuratively. We saw this wave of hawkish anxiety ripple across global central banks almost instantly.
We really did. I mean, by Thursday, you had European Central Bank official Isabel Schnabel explicitly warning about this.
What did she say exactly?
She warned that a broader Middle East energy shock could tear through the global economy even faster than the inflation surge we saw back in 2021. And the Bank of Japan released minutes reflecting the exact same anxiety, deep fears that this specific oil shock could trigger a return to 1970s-style stagflation.
Let's actually pause and explain the mechanism there, because stagflation gets thrown around a lot.
Yeah, it's a scary word for traders.
It is. Why does a conflict in the Middle East make central bankers in Europe and Japan panic about inflation? Well, it all comes down to the idea that an energy shock acts as a lagged consumer tax.
Right.
If the price of oil goes up and stays up, it makes everything more expensive to transport and produce. Consumers suddenly have to spend a larger chunk of their paycheck just filling up their gas tanks and heating their homes.
It drains their wallets exactly like a tax hike would.
Exactly. And when that happens, the central banks are backed into a corner. They have to keep interest rates high to kill off whatever demand is left, which stalls economic growth. So high inflation plus stalled growth equals stagflation.
And that's the exact nightmare scenario the ECB and BOJ were warning about.
Yeah.
But while the macroeconomic world was sweating over oil and inflation, the tech world decided to have a literal physical meltdown of its own.
Oh man, this was crazy.
On Thursday evening, around 5:29 p.m. Eastern Time, Amazon Web Services suffered a massive outage.
And what blows my mind about this is the cause. I mean, we use terms like the cloud and virtual infrastructure, which makes it all sound so ethereal.
Right, like it's just weightless and floating.
Exactly. But the reality is the cloud is just millions of very hot, very loud metal servers sitting in massive warehouses. And those servers need air conditioning.
They really do. This outage wasn't some complex cyber attack. It was just an uncontrolled temperature spike in a single U.S. East 1 data center.
So the AC just broke.
The cooling systems failed.
Yeah.
And because AWS is the foundational backbone for a huge swath of the modern internet, that single hardware failure in one building cascaded outward. It disrupted downstream platforms globally.
Right.
Coinbase, for example, started experiencing major transaction difficulties purely because of this cooling failure.
It's the ultimate reality check. It perfectly illustrates how the physical economy absolutely constrains the virtual economy. I mean, you can have the most advanced software on Earth, but if the air conditioner breaks in China, your crypto exchange goes down.
Exactly. So if you put yourself in the shoes of a trader waking up on Friday morning, the dashboard looks incredibly grim.
Yeah, very red.
You have supply chain chaos and missiles flying in the Middle East. You have global central banks threatening to keep policy tight because of energy fears. And you have critical tech infrastructure physically overheating.
It sounds like the perfect setup for a massive market sell-off. We're going to take a short break here, but when we come back, we'll explore the U.S. data that completely flipped the market's mood.
Welcome back to the Deep Dive. Let's move right into Session 2. What moved markets during U.S. trading hours?
Yeah, so let's talk about 8:30 a.m. Eastern Time on Friday. The monthly jobs report drops, and instead of a sell-off, the market absolutely rockets upward.
The numbers in that report completely flipped the narrative. Non-farm payrolls came in at 115,000, which completely smashed the consensus forecast of just 65,000.
I mean, that is a huge beat.
It is. But here's the critical nuance at it. The unemployment rate held completely steady at 4.3%, and average hourly earnings grew by 3.6% year over year.
Okay.
That wage growth number was actually cooler than economists expected.
All right, let's translate why Wall Street threw a parade over that specific combination of numbers. It's what everyone calls the Goldilocks print, right? Not too hot, not too cold.
Exactly, the sweet spot.
If payrolls are up but unemployment is steady, it means people are finding work, which means the consumer base is resilient. People have jobs so they can keep spending.
Right.
But, and this is the magic part for the market, because wage growth was only 3.6%, employers aren't being forced to drastically overpay to attract talent.
There is no runaway wage inflation. And runaway wage inflation is the number one thing that forces the Federal Reserve to keep interest rates punishingly high.
Yeah.
So the market looked at that 3.6% wage growth and basically saw permission for the Fed to eventually lower rates. And equities responded instantly.
Oh, they definitely did.
The S&P 500 jumped 0.8% to close at 7,398.93. And the Nasdaq climbed 1.7% to hit that new record high.
But, the celebration wasn't unanimous. Beneath that headline rally, there was a really fascinating battle of narratives playing out on the news wires all Friday morning between the White House and the Federal Reserve itself.
You had two very different interpretations of reality hitting the tape within hours of each other.
It was almost funny.
Right. At 9:12 a.m. Eastern Time, White House advisor Kevin Hassett goes on air, completely touting this rip-roaring jobs market.
Rip-roaring.
His exact words. And he confidently predicted we're going to see rate cuts this year. He specifically pointed to the incoming Fed chair, Kevin Warsh, as the catalyst for that upcoming policy pivot.
Okay, but then the actual Fed steps up to the microphone.
Yes. At 11:06 a.m. Eastern Time, Chicago Fed President Austin Goolsbee speaks, and his tone was just a bucket of cold water.
Yeah.
He voiced real, tangible pessimism on the progress of disinflation. He explicitly warned that sticky services inflation is actually moving in the wrong direction right now.
See, hold on. This is where I really struggle to understand Wall Street's reaction. We have the market aggressively pricing in these rate cuts based almost entirely on the assumption that incoming Chair Warsh is just going to slash rates when he takes over.
Yeah.
But isn't that fundamentally mistimed? The Federal Reserve has been explicitly clear that they're entirely data dependent when it comes to inflation. Mm-hmm. And here is a sitting Fed president, Goolsbee, essentially waving a red flag saying, hey, the inflation data is not cooperating. Are investors just blinding themselves to micro-level risks because they are so obsessed with this broad macro narrative of rate cuts?
Honestly, it's a classic case of the market pricing in the destination and ignoring the very bumpy road required to get there. I mean, equities are currently pricing in a structurally lower discount rate under new Fed leadership. They're looking 6 to 12 months down the line.
Right.
But you're right, getting to that lower discount rate requires the inflation data to cooperate today, and Goolsbee is saying it just isn't.
And it's not just the inflation data they are ignoring. They are actively looking past the geopolitical chaos we talked about earlier. Those Thursday clashes in the Strait of Hormuz didn't just end. They escalated right into Friday's intraday trading session.
They did. Between roughly 1 p.m. and 2 p.m. Eastern Time on Friday, the U.S. military actively stepped in and disabled Iranian ships that were attempting to breach the blockade. And during that exact same window, Iran successfully seized a commercial oil tanker, the Ocean Koi.
Wait, I need to stop you there. Iran literally seized a commercial oil tanker in one of the most critical energy choke points on Earth, while U.S. forces are actively disabling ships.
Yep.
That sounds like the exact scenario that should send crude oil prices to the moon and crash the equities market, but it didn't.
It didn't. Crude oil specifically, West Texas Intermediate, or WTA, actually slid intraday. It went down to $94.31 before eventually settling at $94.72.
How is that logically possible? How does a tanker get seized and oil gets cheaper?
Because the market is refusing to treat these clashes as unpredictable, chaotic, natural disasters. Instead, traders are looking at this through a game theoretic lens.
Okay, unpack that.
If you view these events as geopolitical brinkmanship, they act as game theory leverage. Think of it like a very high-stakes game of poker where everyone roughly knows what the other players are holding.
Right, no one wants to flip the table.
It's exactly. Both the tanker seizures by Iran and the highly controlled nature of the U.S. strikes are calculated moves. They are designed to gain leverage at the negotiating table, not to accidentally trigger a global war. Iran still needs to sell oil.
And the U.S. wants to protect shipping lanes.
Right. Neither side benefits from completely destroying the strait.
Okay, that poker analogy actually makes perfect sense. The traders are betting that the violence, as scary as it is inherently capped by self-interest.
Yes.
And you can see that exact same calculated calm reflected perfectly in the credit markets on Friday.
The credit markets are always the tell.
Always. For anyone unfamiliar, credit markets, specifically high-yield corporate bonds and investment-grade corporate bonds, are basically the canary in the coal mine for financial panic. If the world is actually ending, or if the economy is actually crashing, credit markets freak out first because bondholders get terrified that companies will default on their debt. But on Friday, high-yield bonds and investment-grade bonds showed practically zero volatility intraday. The equities market rallied, and the credit market just shrugged and went about its day.
The bond market wasn't panicking, but it is worth noting that the Federal Reserve formally acknowledged the powder keg we were sitting on.
Oh, yeah, they did.
At 4:01 p.m. Eastern Time on Friday, just after the closing bell, the Fed released its Spring 2026 Financial Stability Report. And in that official document, they ranked geopolitical risks as the absolute #1 threat to the financial system, with an oil shock coming in right behind it at #2.
So the Fed is fully aware of the poker game happening in the Gulf, even if traders are trying to look past it.
Exactly. So to recap the session, equity bulls rode the Goldilocks labor data, basically ignoring both hawkish Fed warnings and Gulf explosions. We'll take a short break, but next we will unpack the massive corporate developments happening beneath the macro surface.
All right, welcome back. Let's jump into session 3, corporate events recap, and what to watch next.
So while the macro world was obsessing over oil and inflation, the corporate landscape was going through some tectonic shifts on Friday.
Massive shifts.
Let's start with the 12:48 p.m. Eastern Time report that hit the wire regarding Apple and Intel. They have reportedly reached a preliminary agreement for domestic chip production.
I mean, that is a staggering development. It sent Intel shares surging 13% almost instantly.
Right.
But the implications are so much bigger than just a bump in Intel stock price. We are talking about Apple fundamentally rewiring its supply chain. For years, their entire model has relied heavily on Asian foundries for chip manufacturing.
Yeah.
Moving that production domestically to Intel is a massive physical onshoring of the digital economy.
And it speaks directly to the geopolitical anxiety we were just discussing. Apple isn't doing this just for fun. They are recognizing that relying on overseas manufacturing in a world with increasingly fragile shipping lanes and geopolitical tension is a massive liability.
They want physical control over their hardware.
Exactly. And speaking of hardware, the market's hunger for computing power is driving some incredible capital market activity right now.
You're talking about the Cerebra's IPO.
I am. At 3 p.m. Eastern Time, the AI chip maker Cerebra's filed an update ahead of their IPO showing that they are officially raising their price range to $125 to $135 per share.
And the reason they can hike the price like that is because the offering is reportedly more than 20 times oversubscribed.
Wait, 20 times?
20 times. Investors are practically banging down the door to get in on this. It perfectly illustrates how AI CapEx has become this cycle-agnostic arms race. It genuinely does not seem to matter what the Fed is doing with interest rates or what is happening with inflation or if there's a blockade in the Middle East. Enterprise companies and investors are absolutely ravenous for computing power. They view AI infrastructure as an existential necessity, and they are willing to pay an unbelievable premium to get a piece of it.
It's just a completely different gravitational pull than the rest of the market.
Yeah.
And we should briefly mention two other notable developments that hit late Friday afternoon before we wrap up the week. First, on the regulatory front, at 1:24 p.m. Eastern Time, the U.S. government sought a massive $400 million settlement from TikTok over privacy violations.
Which is another layer of geopolitical tension playing out in the tech sector.
Exactly. And then, shifting to global diplomacy, at 2 p.m. Eastern Time, President Trump announced a temporary ceasefire in the Russia-Ukraine war, running specifically from May 9th through May 11th.
And Russia accepted the truce plan.
They did. And that provided a slight but noticeable easing to European risk premiums as traders headed into the weekend.
Well, folks, as the closing bell rings, it is incredibly clear that Wall Street has a very, very specific definition of a perfect economy right now.
Oh, for sure.
We have warships dodging missiles in the Strait of Hormuz, an Amazon data center literally overheating, and the Fed openly warning us about sticky inflation, yet the Nasdaq still happily sailed to a brand new record high.
It's wild.
I guess nothing says risk on quite like aggressively buying tech stocks while the world outside catches fire. Honestly, at this rate, the only thing hotter than Amazon server room is the massive investor demand for AI chips.
Yeah, true.
So enjoy the weekend, celebrate those tech gains, and maybe use some of those profits to invest in a really good fire extinguisher.
I love that. And while you are doing that, here is exactly what you need to watch heading into next week. First, keep a very close eye on that Russia-Ukraine ceasefire window from May 9th to 11th.
Right.
If there are any headlines about violations of that truce, it could immediately hit crude oil and gold prices. Second, China's April CPI and PPI data drops on Monday, May 11th at 1:30 a.m. Eastern Time, which is going to be a crucial indicator for global commodity demand.
Yep, that's a big one.
Third, the U.S. Treasury 3-year note auction happens Monday at 1 p.m. Eastern Time. Fourth, U.S. April existing home sales are released Monday at 2 p.m. Eastern Time. And finally, the U.S. 3-month and 6-month Treasury bill auctions will hit Monday at 3:30 p.m. Eastern Time.
So as you digest all of this, I want to leave you with one final thought to mull over. We've talked a lot today about the sheer physicality of the tech world.
Yeah, we have.
Geopolitical tensions are forcing a giant, Apple to radically shift its supply chain and physically build chips domestically with Intel. And we saw firsthand how fragile physical data centers are literally overheating and failing just trying to run basic internet services.
Right.
So if the hardware is this messy, this fragile, and this physically constrained, how much longer can software and AI equity valuations continue to float in the clouds and defy the messy physical reality of the hardware they actually run on?
That is the million-dollar question. We would love to know what you think about that and about Wall Street's chaotic week in general, so please drop your thoughts in the comments below.